Let's start with that question of monetary policy. People are expecting the Fed to keep hiking at least for a while. What does that mean for the credit markets you deal with?
Yeah, so we generally deal with levered credit, and I think that we are of the view that there are likely to be one more hike. Maybe there's two more hikes. I think that in general we're sort of closer to the end of Fed hikes than obviously we are to the beginning. So I think we're coming to the tail end of the hike cycle, and people are starting to now look at 24 and when is the Fed going to cut and what are the indicators they're looking at that would make them cut.
So when I checked it this morning on the Bloomberg, the spread for high yield, just to take high yield, was something like above 450 basis points. Where do you expect that to be going? Is that where we end up, or is that going to continue to rise, and if so, when?
Yeah, so I think you got a big push and pull, which is that base rates are pretty high, north of 5%, and then you've got spreads that are actually not that wide, and perhaps not representative of the risk in the corporate credit market. And I would actually say that's true for investment grade as well. I think investment grade is, 140 over plus or minus, and high yields in the sort of low to mid 400s over. So I think our view is credit spreads are not indicative of risk necessarily. Yields all in are reasonably wide, so that's the trick. And I would suspect that you'll see spreads go a little wider, primarily because we do think you're going to continue to see some margin deterioration for levered credit, number one. And number two, we do think we're in a bit of a longer, sort of higher for longer rate environment, which will pressure cash flows as well for corporates.
Well, take us through how it works in credit, the mechanics of it, because I've seen some reports that there may be a delayed response because some companies, and this is both for investment grade but also for high yield or leverage loans, locked in rates, at a lower rate. That's coming due in the next couple of years, I'm told. A fair amount of money's coming due, and it may be a little difficult to get it refinanced at acceptable levels.
Yes, I'd sort of take that into two pieces. So in general, you got a bunch of fixed rate bonds, whether that be investment grade or high yield bonds, that were issued at a different moment in time in the market when the 5-year and the 10-year were significantly lower. Those fixed rate bonds are a real asset right now in the current rate environment. I think on the second end of the spectrum, you've got the loan market, which is a large market, which is all anchored on a base rate plus a spread. And so as that base rates move from 1% to north of 5%, that's hurt businesses a lot. So if you think about sort of corporate balance sheets, an incremental 400 basis points of cost of leverage on their debt stack that is loan related has been pretty painful. The second part of your question is maturities. It actually happens to be that the sort of quote unquote maturity wall is reasonably benign in the next year or so. But as we look forward, if we are living in a kind of longer, or I say higher for longer environment, eventually these companies have to refinance. And eventually that cost of financing is going to be a lot higher. The only other thing I would say is in some of the instances of the high yield market and the loan market, there are folks who have hedged their rate exposure from day zero. That also is obviously a real asset today in today's environment. Not a ton of them, but some of them did.
As we look toward refinancing, has the bargaining power shifted between the lender and the borrower? There was a report actually just this week that KKR had to make concessions to lenders to refinance a deal on a Dutch food company. Without talking about the specifics of that, are you seeing that phenomenon, or do you expect it more generally? We had Covenant Light. Maybe we're going away from that.
Some of these bigger, well-known businesses that are large corporate capital structures, there are some covenants and stuff that are getting put in place when they're being issued through the liquid markets. But I wouldn't say there's been a huge sea change. It's gotten better, but I wouldn't say there's tons of covenants. I think the documentation structures have certainly gotten better, though. So I think that's one. Two is the loan and high yield space. The issuance numbers have been very anemic this year. So there hasn't actually been a ton of net new issuance. The third thing I would say is where there has been, I'm not sure that it's been a change, or there's been continued more balanced power between the issuer and the provider of capital is in the private credit markets, which has been open for business, unlike the liquid markets. And the private credit markets tend to be able to defend better structures and better documentation in general. And in today's environment, when the liquid markets or the capital markets, if you will, are not sort of wide open, for issuers, the private credit providers have been able to step into those shoes in many instances in pretty large deals.
One of the things that we have read about is a shift away from banks and toward private credit as the banks have to step back, particularly in light of what happened in March. People are stepping back. Are you seeing a substantial shift over to private credit from the banks and other sources?
I would say that shift has happened already over the last several years, and the private credit market is actually, on par or slightly in excess of the size of the syndicated loan market today. If you believe sort of what we see in terms of estimates, that growth will likely continue to increase. And I think one of the big questions around how quickly it'll increase and where it will end up landing is a little bit a function of how tight credit conditions continue to get and then how long they stay there. Because lending standards have tightened up. It didn't get tight as I think people had estimated the numbers to be significantly more impactful after the March regional bank failures. I'm not sure we've seen the full impact of it yet, so I think that's a remaining question. But I do think that you'll see that private credit market continue to grow, and it's exceeded the size of the syndicated market.
Purnima, you mentioned earlier credit risk. We've heard a lot of talk by economists about the recession. It's been predicted for a long time now. It seems to be getting put off into prediction. Do you think that the markets, and particularly that spread that we talked about earlier, is that accurately reflecting what you think of as the possibility of recession?
No. I mean, if you look at the median high yield spread over, I guess if you say post-crisis and you sort of take out COVID, there's lots of ways one can slice these numbers. The median high yield spread is north of 500 basis points over. That has been in a 2 to 2.5% GDP environment. Today, we're in the low to mid 400s in a pick your number on GDP. Zero, the estimates are all over the map, but 0 to 1.5%. So definitionally, that's not on par.
Do you position yourself as an investor to be able to buy credit? Are you expecting essentially prices to come down so there are bargains to be had out there? Are you building up dry powder?
I think there's places to add risk right now because I think that overall in the loan market and in the high yield market, even in the securitized credit market, in general, yields are sort of 8 to 10%. So I think in a lower growth environment, with a higher rate environment, potentially a sustained higher inflation environment, tightening financial conditions, I actually think in that 8 to 10% zip code, that's a pretty good place to earn yield. However, I do think that I think credit spreads are not indicative of it. I think a lot of that yield is coming from base rates, over 50% of it in most instances. So I think you kind of got to be a little bit careful in terms of where you are. And I suspect you're going to have moments over the next sort of, 12 months where there will be some good amount of volatility. And that volatility can come from a variety of places. But I think you'll continue to see some margin degradation. And I think that probably gives you some moments to add more risk as well. But I think, short duration, well-capitalized businesses are a pretty good spot to live in that zip code of 8 to 10%.
And finally, Purnima, you mentioned anemic issuance, particularly in high yield. We haven't seen a lot of M&A, certainly not the way we had in the past. Is that coming back? Because traditionally, as I understand it, a lot of the high yield is coming out of private equity doing buyouts.
Yeah, I think we're seeing. I think eventually, yes, is the answer. I don't think the capital markets are sort of quote unquote open for business yet. I think as you continue to see volatility subside, you will likely see the M&A pipeline open up a little bit. But as we sit here today, there's a lot of, I think you alluded to this earlier in one of your questions, but there's a lot of digesting that's still happening in terms of corporate balance sheets and cash flows. And we haven't quite gotten to the very end of it yet. So I do think it'll come back, but I think you also have to sort of see volatility continue to be sustained at a bit of a lower level.